Welcome to Cashflow statements. A cashflow statement is a statement that tells us how much cash has moved in and out of the business over the last 12 months for the last year. And we have 3 sections within a cashflow statement, which are summarized on the right hand side. Section 1 covers the operating activities for a business. These are normal business operations that happen every week, every month, and day in, day out. So such as buying stock, selling stock, and the processes within that. Number 2, second section, is investing activities. This shows us the cash flows from the businesses investing into. If you think what kind of business invest into, they can invest into buying non-current assets like premises, property, machinery, or they can invest into other businesses, buying shares in other businesses, or put their own money in a bank account and therefore receive interest. If they invest in other businesses, they might receive dividends from those businesses as they own shares in them, and also that there's going to be a cash flow regarding non-current assets. If we buy non-current assets, that means money would have gone out of the business over the last 12 months. If we sell our own non-current assets, money would have come in for the proceeds of that sale, and we would have received that. And number 3, financing activities. And this section will show us the cash flows relating to the financing of our business. And we finance our business through shares and share capital. So we could issue shares, sell shares, and that would have raised cash. We would have received cash if we had done that this year. Or we could buy back our shares. We would have then therefore lost cash from our business if we had bought back our shares. We could either also receive a loan or borrowings. If we received a loan, we would have obviously got cash, received cash over the last 12 months. If we paid back our loan, we would have lost cash. And that this cash flow statement essentially shows cash received or paid out over the last 12 months in relating to number 1, operating activities, section number 2, investing activities, or section number 3, financing activities. So this cash flow statement summarizes the cash flows in and out of our business to do with those 3 sections. So what's the use of a cash flow statement? Number 1, some people see profit as less meaningful because it can be manipulated through changing certain policies within our accounting for an income statement or statement of profit and loss. Whereas a cash flow statement basically shows us a more objective look at performance by looking at actual cash received and paid out during a year. Secondly, this cash received or paid out during the year could be a good way to assess if an investment is worthwhile, such as when we do investment appraisal and look at net present value of a project, we're looking at the cash flows, and this indeed shows us the cash flows over the last year, so we can assess a project in terms of how well it's done in terms of cash flow, so we could use it there. So let's quickly go over a cash flow statement. For the longer version, where I do calculations for the figures, you can see in the link below to access that. So we start with the title, Statement of Cash Flows for a year that ends, and then you pick your year-end date. In this case, it would be the end of the year 2024. Every section has a title, which is underlined in blue. So the first section, as we saw over here, is about operating activities. So section 1 starts with the title Cash Flows. So this section shows us the cash flows from operating activities. And then section 2 starts here, where it's underlined in blue, cash flows from investing activities. And section 3, as we saw here, financing activities, starts cash flows. This is the title of section 3, cash flows from financing activities, and we'll go through each one. So section 1 starts with cash flows from operating activities. The first number here is profit from operations, which we can see from our limited company or incorporated business income statement or statement of profit and loss. So it's otherwise known as profit before tax. So we bring that in from the income statement, statement of profit and loss. And then what we're going to do first is add back to that any depreciation or amortization. Okay, so what we're doing in the first section is using, in this case, what we call the indirect method. So what we're doing in the indirect method is we are taking operating profit and adjusting it for non-cash items. Items that have, things that have happened within our business that have affected the income statement or statement of profit and loss, and what we're doing is reversing the effect. So for example, if we had depreciation or amortization, this is basically the loss in the value of non-current assets, that would have decreased profit in our income statement or statement of profit and loss. And if that's the case, we're going to reverse the effect and add that back on. Secondly, any change in receivables. In this case, we've got an increase in receivables, let's say, but we could have a decrease. If we have an increase in receivables, that comes about because we have got more credit sales. And increasing credit sales, in terms of the income statement and what it does to profit, it increases profit. So we increase credit sales and the sales increases, then profit goes up in the income statement or statement of profit and loss. And what we're going to do is do the reverse and take it back off. If there's an increase in trade receivables from last year to this year, then essentially we take that figure off. If there's a decrease in trade receivables, we're going to add that figure on. If there's an increase in trade payables, we're going to add that. If there's a decrease in trade payables, we're going to minus it. Okay, so if there's an increase in inventory or stock from last year's financial position or balance sheet to this year's financial position or balance sheet, if there's an increase in inventory, what that does to profit is it increases profits. If closing inventory is higher, then it increases profits, so we're going to do the reverse and take it back off. And then if we've also had a profit on disposal of any non-current assets, what that does to profits in the income statement or statement of profit loss is that increases profits. So we're going to do the reverse and take it back off here. So essentially we're doing the reverse here of how these items would have affected our income statement or statement of profit loss profit figure. So if any item here would have increased profits, we take it off. If any item here would have decreased profits, we add it back on. Obviously, like I said here, if we have an increase in trade payables, we add it on, but if it was a decrease in payables, we would take it off, we would do the reverse. So this is what we do in section 1. That takes us from the operating profit, which is within the income statement or statement of profit loss, and then we are going to, in this case, take the 500,000, add the depreciation, and then anything we're going to minus is in brackets, so we minus the 10, add the 15, minus the 8, minus the 12, and that gives us 505,000. Then we have to do, so this gives us cash generated from operations, from operating activities. However, if we have paid tax this year, and the word paid means literally it has gone out of our account. If tax has been paid and cash has left our business, or indeed if interest has been paid, similarly cash has left our account, then we need to take those two off from the 505. So we minus the 5,000, we minus the 10,000, and that gives us £490,000. Now this is the net cash from the operating activities section, and we put that on the right hand side. So we put the totals of each section on the right hand side and the workings on the left hand side. Okay, so that's our summary of what's happened in terms of cash flows from operating activities in our business. The next section is cash flows from investing activities. As said here, investing activities, what could we invest in? Buying non-current assets or selling non-current assets, anything to do with non-current assets would go here. So you could say this is anything to do with non-current assets and investing in other businesses. And we could put our money, also invest into bank accounts. And if we do, then we would or could have these following adjustments. So if we purchase non-current assets or machinery, we would have lost cash. So now we are not doing the indirect method. We only did the indirect method for the first section. So now we're just accounting for what has actually happened to cash over the last year. So if we bought non-current assets or machinery, then we could have only done that by spending cash, losing cash. So we have lost £60,000 or dollars of cash over the last year. So we show that as a 60 in brackets as a minus. Proceeds from selling of non-current assets. If we have sold non-current assets in the last year, then we would have generated some or received some cash, and we show that as a positive cash received from investing activities. In this case, both of these are related to non-current asset movements. Like I said, if we invest into other businesses, we could receive dividends. If we put our money into a bank account, we could receive interest. And if we have done so, that goes here as well. And if we've received cash, then that shows as a positive. So in this case, if we've lost 60, we've gained 20, we've gained 5, and we've gained 15, that's an overall loss of minus 20,000. So that, again, since it's the total of this section, is moved over to the right-hand side, right-hand column. And since it's the total for this section, we then call that net cash used in investing activities, and it goes there. The last section, cash flows from financing activities, has, and remember, financing, how we can finance our businesses through shares or loans, is mainly the movement of cash to do with shares or loans over the last 12 months. So if we have sold or issued shares, we would have received cash, that shows us a positive. If we have received a loan, that shows us receiving cash, positive cash. If we pay off a loan, we would show that as in brackets as a minus over here. But in this case, we're saying we have received a loan this year. So that basically means we owe more in loans now than we did a year before, because we've received more loans from a bank. And since we are talking about shares here, then if we have to pay dividends, that will go in this section too. If we're paying dividends, that will be that money has left the business. We show it as a minus. So if this is what's happened in this case, then we would have the 100 plus the 100 minus the 70 that in terms of dividends we've paid, and the total of this section is also moved over to the right hand side, would be 130 positive movement in terms of cash at the end of the year. So then what we can do is look at the right hand side. We have received net £490,000 of cash or dollars. From section 2, investing activities, we have lost out in investing activities 20,000 cash. And from financing activities, we've done well again. We have received from financing activities 130,000 this year. Now, if you then add up all three, 490, we have to minus 20, that makes 470, and then add 130, that makes a total of 600,000 cash gained from the activities over the last 12 months. So this is called net increase in cash and cash equivalents. The net increase, the overall increase by looking at all three sections is 600,000. And that's from a positive gain of 490, a loss of 20 from investing activities, and a gain of cash of 130 from financing activities over the last 12 months. So here we can see, if we look at the gain of 600,000, that should explain why the cash and money in the bank is 600,000 more in this year's balance sheet or financial position from last year's balance sheet or financial position. That shows where the cash gain has come from, and we can track it back to the activities within the operating section, the investing section, or the financing activities within the business over the last 12 months. Now, if you want to see me go through a full question with numbers, that's going to be in the full video in the link below.